In this video, we're going to talk about Progenity, trading under the ticker symbol PROG. We're going to cover the price action over the past few days, the company itself, and the recommendations regarding buying, holding, or selling the shares. If you would like to see more stock analysis videos, please like, comment, and subscribe to my channel. But before today's video begins, I'd just like to clarify a few things about the timing when my videos are recorded, uploaded, and how much they react to the latest market updates. Those are prepared, recorded on the day before, and scheduled for the next day. If there are significant and volatile movements during the trading day, they will not be reflected in the video itself. With that being said, to the extent possible, my analysis will be based on the medium term, or even the long term, and not necessarily on the intraday movements. The main reason why it shouldn't matter that much is because most people investing in stocks, or even just trading in and out of their positions, usually keep their positions open for at least a few weeks. With that being said, if there are significant movements in the stock price that happens afterwards, either they will not affect the overall picture, so in that case we will cover them the next time we're supposed to cover them, or if they are significant enough that they change the outlooks, then yes, I will do a follow-up video in the shortest delay possible with a reevaluation of what I think should happen next. Progenity is a small cap company operating in the sector of biotech, developing products like molecular testing. Looking at its projects, it feels like what it does is similar to what BNGO by Nanogenomics does. And they may take a while before they have an actual operational cash flows coming in, but in the meantime, they have to dilute shareholders to keep the ship afloat. So, we have actually seen this kind of scenario with quite a few other startups in the same sector. And this means that at least in the short term, fundamentals may not look that good. The main reason why Progenity is trending in conversation online is because the company is part of a short squeeze operation between those who want to push the stock price lower and those who want to squeeze out those short sellers. It is one of the more volatile stocks in 2021 and hereby provides a lot of opportunities to profit from its up and downs, in addition to the potential gains from the short squeeze. The market cap of Progenity is currently about $800 million, and the enterprise value is $902 million. The market cap is the price tag that financial market is willing to pay for Progenity right now, considering its future potentials and the short-term fundamentals. The enterprise value of the company is the net result of the company's assets once all the debts are paid off. Usually the market cap is higher than the EV, but sometimes, due to exceptional scenarios, it's the other way around. For example, maybe the company is highly leveraged, or like we have right now, the company is under a lot of short selling. The company may be under a lot of short selling pressures. Quick ratio of Progenity is 0.9, and the current ratio is 0.9 as well. The debt over equity is currently minus 0.89. In other words, Progenity isn't leveraged very high and it's highly liquid. The average trading volume Progenity has been 97 million shares over the past 10 days, and the daily volumes have been 122 million shares, 79 million shares, and 221 million shares in the recent days. The 1-year beta of Progenity has been minus 0.08, but this doesn't mean much because it's a relatively new stock trading in the stock exchange. It's actually very volatile if you look at the chart. Its 52-week high has been $7.86, and its 52-week low has been 66 cents. Now, let's go to the options market for Progenity. In terms of volume and open interest, the options market seems to clearly favor the calls options. Generally speaking, the put options give you the right to sell at a strike price if you expect the stock to go lower, and the calls would mean that the stock expects the price to move up because it gives you the right to buy the stock at a certain price. So the key strike prices where there seems to be the most interest are $3, $5, and $7.50. So far, Progenity has demonstrated that it is on its way to win against the short sellers who have launched a short selling operation on the company a month ago. The stock has gone to penny stock territory in September and rebounded soon after, and frankly never looked back. The reason why the stock is still relevant is because even though the stock price has been going up, the short squeeze is not over. Right now, about 60% of the daily volume is dealt in dark pools, which, at least for half of the volume, is still shorting the stock. What it means is that those with their short positions haven't covered their short positions yet, and because of this, they will keep trying to push the stock down until they run out of capital to do so. The more the stock price rises, the more they would have to consider to cover their positions, because if they don't, they stand to lose a huge amount of money by delaying that decision. This is the biggest appeal to buy Progenity shares at this time, in my opinion, because the short squeeze is something that is based on simple math, whereas the potentials realized on fundamentals and so on will need a bit of luck and crystal ball reading to determine whether the company in the earlier phases of their economic cycles, including but not limited to Progenity, will actually be able to realize what we think they will be able to achieve. In other words, assuming that Progenity's stock price doesn't collapse over the next couple of months, a significant surge in the company's stock price is almost guaranteed to happen. Not because I hope that it would, not because there will be some sort of magic spells modifying the charts that we're looking at. It's just because if the short positions that we know are significant at the moment in the existing exposures, they would have to recover their positions eventually, which is the equivalent of buying a huge amount of Progenity shares. I believe that the upward tendency is unlikely to be reversed at this point, and that the current price point, even if it's kinda high, would justify an entry now if you don't have an existing position. For those who already have a position in Progenity, then I think that it's less urgent for you to increase your holdings now, because you already have a foot in the door, and it would be smarter to wait for some pullbacks. Overall, I would recommend to keep an exposure of around 1% of your portfolio, and if you're willing to take more risks than most other traders, the absolute maximum would be 3% of the portfolio, assuming that you have a diversified panel of stocks able to hedge the inherent risk of one individual stock. In this current market environment, I believe that we should be careful about taking positions and risk in the financial market in general, and in the equity market in particular. Because over the past decade or so, the financial market has been living with the help of newly created capital from QEs, resulting in a massive increase of asset prices and the corresponding decrease in their yields. And the low interest rate also contributed to reinforce this phenomenon, because the financial sector would see its profit margins reduced, and in turn keeps the returns of other sectors and employees low as well. At the same time, the market doesn't represent the real economy, and the real economy doesn't get reflected in the price of different securities. The market is a game of supply and demand, which will depend on a number of factors, not just the fundamentals. If the asset prices only depend on the fundamentals, then their performances in the Northern Hemisphere would have been more than mediocre, because things have been mostly stagnant over the years. A few things can explain why asset prices managed to remain high despite the stagnation of the underlying businesses. The first one is that over the years, there has been more money printed by different central banks to support their own economies. But because that money is distributed to banks and expected to loan to businesses to create more jobs, and that in fact there aren't that many opportunities out there, this money became capital that travels around the world and went into the huge financial melting pot. The QEs are now wrapping up in many countries, so I don't think that it'll remain as the main driving force over the next couple of years to keep the asset prices up. But it's compensated by the arrival of new capital from different regions to North America, because it's perceived as a safe haven for investors. With the rising tensions around the world, this capital inflow will probably be sustained over the next couple of years, if not intensifying. The last phenomenon is the creation of artificial bubbles that are either supported by real market trends or completely fictional ones to allow market participants to play the game of hot potato and to either create profits or to safekeep their capital. The EV sector back in 2020 is an excellent example of this. But nevertheless, what it means for the market is that the degree of uncertainty is probably going to increase over the foreseeable future, as the expectation for a recession has been building up for more than a decade, and that the economic difficulties are accumulating around the world, especially from Asia. What this means for the market and for us is that the volatility is supposed to increase over time, which will provide opportunities to make a profit or to incur losses, depending on the timing and risk management. Another thing to note for this period of time is that we have to be very careful about having shorts. It's already riskier than having longs because the losses of shorts are not limited, right? Because there's no limit in terms of how far the stock can increase. But with the increased involvement of short sellers, I believe that the stocks being shorted will have an even higher probability of getting squeezed, which will result in potentially massive losses. So we're also observing more of an irrational behavior from market participants in the sense that very often people will choose to rush in a position not necessarily because the fundamentals are convincing, but because there's a buildup of demand in a specific stock and people will pile in to ride the gravy train with the rest of us. That kind of behavior is highly risky and may result in losses. It's worth pointing out that in 2020 and probably in 2021, the market has never presented that many opportunities, but it was also during that same period of time that many retail traders have incurred their biggest losses. A rule of thumb is that each position should be structured so that even if they don't succeed, they don't impact the portfolio stability. Positions should begin small so that there is an opportunity to average down later. And specifically for the growth stocks, I think that 5 to 10% overall should be a healthy weight for the portfolio. And each stock should represent about 1 to 3% of the positions. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.